I know the Magnificent Seven dominated last year, but why is it especially important now to diversify your portfolio?
Well, it's always important, but I think this year in particular, when you have year-end S&P forecasts coming out that range from 42 to 5,200, when you have a manufacturing sector that's been contracting for a year, but a consumer that's still incredibly resilient, a host of risks, both externally and within the United States, this is a time where you don't want to put all your eggs in one basket. And so I think you obviously want to keep some money in equities. The soft landing probabilities have increased, even though it's not a done deal. But knowing that it might be a bumpier landing, knowing that the consumer might run too hot and rates stay higher for longer, you want to be thinking about all those scenarios. And I think in that case, you want your equities. I still like being focused on the US, relatively speaking. You also want to keep some cash, at least in the short term. 5% yield on cash is almost the same as the median expected return on the S&P this year without the same amount of risk. So having some cash, some dry powder, I think also having some more longer duration bonds. I think the upside on the yield on the 10-year has become smaller now that the Fed has shown it's going to be creative with supply where it issues on the curve. And then finally, I like having some gold, a small amount of gold in portfolio as a diversifier as well. It might not see the same sort of gains as some of the other asset classes, but it's going to help protect you if we have a bumpier landing or one of those various geopolitical risks become reality.
I mean, you're really talking about diversification, equities, bonds, commodities, the whole thing. So you recently had a great op-ed in the Financial Times. The title of it, 4 U.S. Soft Landing Questions for 2024. One of your questions was consumption and basically business confidence. So yesterday we had the Atlanta Fed. It came out with its GDP now. Its Q4 GDP forecast raised partly due to expectations for personal consumption and private investment to increase. Does that answer any question for you, at least any early questions? And does that paint how you want to diversify?
Yeah, I mean, when you say soft landing, and Chicago Fed President Austin Goolsbee recently commented in a speech that it basically has never happened in history. So what we're talking about, even though it's increasingly possible, is still not, an easy thing to do. And I think to get that soft landing, to your point, Frank, the consumer is obviously the most important part of it. It's the vast majority of what drives U.S. growth. And we need a consumer that's not too hot and not too cold. If the consumer runs too hot, service sector wages stay elevated, the Fed can't cut rates as much as discounted. That's going to be a headwind for stocks. If the consumer slows down too fast, then we get companies getting more cautious, laying off workers, and then we see the unemployment rate rising, and the Fed may not react to it as fast as the market would like. So you have risks on both sides of things. I think the data we're seeing so far suggests a consumer that is still resilient and just moderating, and that is exactly what we want to see for the soft landing, but it's not enough. We also need to see labor supply going up, competition for labor going up, so wages coming down because of supply, not demand. And then we also want to see commodity prices lower. That would help bring down inflation without destroying demand. And oil, for the last 2 days at least, is going the wrong way.